Michael, thank you so much for joining us today. I have been reading your newsletters for a few months already. My partner had sent them to me, and I believe he forwards it to a few other people as well. But they
Excellent.
are wonderful and very informative. But first, why don't you tell us a little bit about you?
I happy to be here, Steph. It's always a pleasure to talk with professionals in the space and everything else, because so much of what I do, and thank you for reading the newsletters, is trying to parse from mainstream media to what's it
Reality.
mean for investors? What's really going on? What do we need to watch out for? And so, quick background, I come out of a couple of decades of all aspects of construction and automotive trades. I had an industrial accident, 35 years ago, to where I switched from blue collar to white collar and wound up in the investing, rehabbing, and just main day gig is doing commercial and investor loans. So and for me, it's even back then, which predates all the mass media and everything else, is the constant calls. What's going on? Why did the interest rates go up? Why did they go down? Or why aren't they doing something? And so I just started, doing a lot of reading because I'm an education junkie, and that's what got the email newsletters that I send out a couple of times a month, is just trying to share that consistent reading that I do with investors, so they can look and be able to ask the question why, and we can have a constructive and objective conversation around that.
Okay, that's great. And so based on all of your reading so far, what is happening right now?
I The short answer is, the two fundamentals for generating wealth in the US have not changed. It hasn't changed at all. It's either small business and or real estate.
Hmm.
I and that's the fundamental. So that's what I always am coming back to, as we're answering the why questions. The economy goes up, it goes down. 35 years. Uh, if we were having a recession right now, this would be my ninth walk around the mountain of it. I've had the pleasure of visiting a few more recessions than the media has even caught on with. So it's a very common conversation. I have purchased property. I've purchased more properties at the peak of markets, knowing the markets are going to roll over and go down.
Okay.
It isn't because I wanted to, it's because as an independent contractor in the mortgage business, my income is best at market peaks, and it kind of tanks in the downturns. And in the downturns, which are the best times to buy, my tax returns don't support it. So I've also had to figure out how to generate wealth through real estate and be buying at market peaks, knowing that I am doing exactly that. So I can even facilitate those conversations. Mike, why would you buy in '09 while you're telling everybody the dot bomb is coming from the .com dot bomb, and be able to explain real estate is the slowest path to wealth and the most boring. But you hang on to something for 20 years, the value is going to be up.
And
You know,
rents.
as
Hmm.
as we see the same thing with the equities market, with the stock markets. Pick, spin the wheel of fortune and pick a date and roll 20 years forward. What are the values? Uh, if you are engaging the market with a modicum of intelligence, you can't, it's, oh my gosh, I can't think of some of the stocks that bombed in the dot bomb. We've had them. We've had the WeWorks and everything else. But putting everything on one card is, again, not necessarily the best way. And the same thing with your investors. Rarely do you find an investor that buys just one piece of property and rides. We're always talking about, is this space the correct one? Is this genre the correct one? Uh, is this city the correct city? So that's where even now we're looking at that. It's reading this morning, the residential real estate market. I've got some property outside of Tampa, and they're talking about Tampa residential real estate kind of stinks right now. Overbuilding, the uh, people moving to Florida seems to be slowing down. So that's the headline. Oh, the growth in Florida is slowing down. Well, when you're coming off of 5 years of massive growth, I ask the question, does it make sense to have a little cooling period with
Mm-hmm.
your investors? Apartment buildings, after
Yes.
massive growth, does it make sense for the market to pull back a little bit? Does that mean that apartments are a bad investment? So that's where I start broadening that conversation, uh, to try to reduce the fear. Looking at the longer term trends, the trend's your friend. After Phoenix goes up 25% a year for 4 years, do you want to buy in Phoenix? Maybe not in year 5, but does that mean you're going to ignore Phoenix for the next 37 years? No, it's still, if you like a Phoenix-like market, that's always going to be on your watch list. So that's how I kind of look at the current trends. The fun one right now is if we're going to have a recession, and I've always more so been in the easy landing camp, uh, just because of some of the other aspects going on. The job market's holding up. Because until the job market tanks, which is a trailing indicator, uh, we're not hitting it. The bigger challenge we're having is swallowing the 2-3 years of overcooked inflation. That's what everybody's fighting right now. Uh, which I need to go find some of my older term people that were dealing with in the 70s and 80s to re-engage me on, we survived it, you know. Uh, but that's the bigger one right now.
Mm-hmm. You mentioned that you were buying homes in, I believe, '09, you said, or '08. Can you elaborate on the math behind it? Because you knew it was going to go down. So
I
did you
Yes,
compare that with the taxes you were going to have to pay versus the discount you would get in '08, '09, I'm sorry, in 2010, 2011?
yeah. So different states. I think there's either 7 or 9 states that have a Prop 13 thing. So I also bought in '05. Kind of getting onto the peak of the go-go years. But again, fuller disclosure there. I knew the mortgage market was going to blow up. Zero down, stated income,
Yep.
fog a mirror. Hello, I was out there screaming from the rooftops, but a few people listened, but most didn't. Um, while I bought another property to live in, all of my peers were buying nice, wonderful $1 million houses up on the hills. I bought a duplex rehabber in Sunnyvale. So during the downturn, I had rents from the other house. I house hacked my own place, so I had roommates. So all of my friends lost their $1 million homes, and I still had my duplex. Property taxes went down in '09, 10, 11, which I loved that. I was riding an adjustable again. Bad news on the market, interest rates go down. So I chose an adjustable to walk through that. And I just sold the property here last month, and let's see, I sold it for 3x what I paid for it.
Mm-hmm.
And it was a duplex. If it had been a single family, it would have been 4x. But if it had been a single family, the numbers not having the extra cash flows,
Yep.
I would have lost it. So again, being very cognizant of the market and looking at protective strategies. And at those peaks in the marketplace, my conversation with my clients are, how are you going to weather downturns? Most of my clients are well positioned with name the Fortune 5,000 company that they work for, and they're confident that they're not going to be the ones getting laid off. So that's a completely different dynamic than our computer programmers in the odd years, 03 to 05. They all became realtors and mortgage professionals because it was taking them on average 24 months to find a job programming. That was one of those little recessions that didn't hit the country, but boy howdy, it sure hit Silicon Valley. So we
Mm-hmm.
had we had one of those unnamed recessions, 03 to 05.
And you said that, there is a soft landing, in your opinion, happening because of the jobs market. What I heard, and I don't read as much as you, is that they changed how they measure that. Is that
Isn't
true?
that interesting? Yes. Also, I forget the acronym for the group that determines we have a recession. They never name a recession until we've been in one or had one 9 months previously. So I look at the
Hmm.
numbers a little bit differently. We had a recession. It was called COVID. We had 2 months of negative GDP growth, which historically was always the hallmark for what is a recession. And amazingly, the group didn't call that as a recession. I don't know about you, COVID hurt many people, many businesses. It was a recession depression. Another one of those. I call it. I call it because the technical merits. When you have 10% unemployment rate, you are dancing between recession and depression because your money spent to maintain life, love, and the pursuit of liberty in this country, when you've got 10 out of every 100 people are not working, that math doesn't work. That's when it hurts. And in every one of these downturns, there's sectors that benefit. In the equities markets, you talk to good stock traders. They term them defensive stocks. Defensive not being the defense industry. Defensive stocks are ones that are generally do better in downturns, which unfortunately is things like liquor and tobacco.
And nail polish.
Okay. Yeah. Thank you.
You're
You
welcome.
you you gave me a little bit more education on that. I'm usually nail cleaners, but thank you for that. And those are the things I like having those analogies because it's about getting our clients to laugh with us while we're talking with them. Laughter for a couple of reasons. It's a better emotion to be making decisions from.
Mm.
When you're laughing, you're going to, depending on which guru you talk to, you retain between 1.5 and 5 times more information when you're laughing than when you're crying.
Hmm.
That's the big reason for me. As an educator, it's not Mikey's a fantastic guru and blah, 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 blah. It's about how I'm able to share the information with you to where you can retain it and be able to use it. And even better, when you're able to share it with your sphere, ultimately to help more people win. That's that's to me the golden rule. The more people you've helped win at the end of the day, the better.
Yep, that's very true. And it always comes back, in my opinion. So looking into the next year and 2 years, what do you think people should be doing right now with regards to commercial real estate investing?
Oh my God, what an incredible time to buy. Oh, and here I get to say I'm generally come across as being a contrarian. Uh, and because we're in one of those notable election years, my joke du jour is when I'm talking with people, if you're a Democrat, I'm going to play a Republican. If you're Republican, I'm going to play a Democrat. The purpose being, you don't need yes folks around you. You need people that are going to work to broaden your thought process, challenge your thought process, and then because I'm not family, friends, invited to the bar mitzvahs, I get to hold my hands up and go, now you get to sleep on it and come back and tell me what you want to do, and then we will execute.
Mm-hmm.
When one of my newsletters here, I think, right before the Fed meeting, when they lowered the rates, I actually put in my newsletter the best time to buy, and this was residential real estate because it was the Resi newsletter, was 90 days ago. When the interest rates were hitting 8% was the absolute best time to buy residential real estate in California.
Yep.
You had no competition and the sellers were scared to death. So you were able to negotiate lower prices. We're in Prop 13. Lower prices mean lower taxes
Yeah.
forever. And geez, when the interest rates drop, I think we're well versed on what to do then. So, then the interest rates have gone back up. Now that the Fed cut, the interest rates have gone back up. Another one of those people going, why is that happening? Well, it's because now they're not expecting the Fed to be continuing 0.5% cuts because, again, the news is out that maybe the economy isn't as stinky as mainstream media would like to talk about. So, now we hear about the hurricanes and not enough blood in the economy. So interest rates are going back up, prices are softening. To me, it's the same thing with the commercial real estate. The cap rates are up. You go back historically and you start pulling cap rates. I still can't figure out why I think San Francisco cap rates are still in the fours. That blows my mind. But I've got clients currently in contract in Oakland, and we're tapping 7.25 cap rates on apartment buildings.
Awesome.
Freaking awesome. Yeah, and is where we're doing agency loans and getting away with, when was the last time you heard 25% down on apartment buildings in California?
I don't do
We're
apartments, so I don't know.
okay. Yeah, it's been a long time. One of my core areas is retail shopping centers. How everybody in COVID was going, oh my God, shopping centers. That turned out to be a great play for people that were in that space. Maybe not the mega places, but all your neighborhood shopping centers were doing well because people still had to go somewhere.
Mm-hmm.
So the shopping centers and also the complexity in the lease agreements there. So to me, they're documentation wise, they're the most intriguing and interesting.
Mm-hmm.
Uh, so the commercial space, it has the challenge that the banks don't know what to do. So obviously office and whatnot. So we need the banking sector. I Offices, I don't have a good feeling for those. They are so specific. We're finally getting back to the you're coming back to work mode. You know, I called that one a little bit too early, but it was funny. One of the first major companies to require back to work with Zoom. So I've been laughing about that one. Yes, as we are, contributing to Zoom here on this call. I, the collaboration, the human dynamics. Humanity is a communal organization.
Yeah.
I, so offices will come back. Apartments, it's become a nationwide problem of not enough growth. Although apartments are having a soft patch right now, but the apartment growth is waning. Permits and under construction, I think in 2025 is supposed to be about 50% of 2024. And yet, as long as people are working, we are going to be expanding households. Expanding households then need more retail, need more apartments, so more commercial. Industrial is finally starting to show a little bit signs of slowing. So I think that's going to be a more targeted, specific infill. So looking, infill projects rather than path of progress. And there's lots of areas for infill, except Silicon Valley. So that's where the commercial, that's where your all's expertise, being able to find those, being able to find the whatever special sauce you're able to add, because we do have a lot of aging properties, and aging properties can be twofold. The property is physically aging, and or the ownership is aging.
Yep. Oh, that's a trend right now. Be able to buy properties from people that are retiring.
Yes, and that's where being able to come in and clean up. The high interest rates, it just requires more down payment, more horsepower going in, but it does not change the fundamentals of the property. It doesn't change what's the trend going to be, because with every downturn, what's the next turn of the wheel?
Yep.
It's an upturn. And then we have to be careful, because with the upturn, what is the next turn of the wheel? So
Exactly.
it's just being aware that, deciding what quarter, everybody prognosticates on that. We don't know until it hits. So that's where just having the numbers. If you're buying at a 7 cap rate and your exit strategy is improving the property, and you're going to exit when the market cap rates are to 5, that's your plan, or to 6, whatever that plan is, so that you're looking and being able to utilize the trends as being your friend.
Mm-hmm. Mm-hmm. Nope, that's 100% true. Sometimes we miss it by a few years. Like my mentor was, waiting since 2016 for the downturn, but it is what it is.
Exactly, and other people that we know that were in for you know reposition properties in 2018 and 2019 with a 5-year hold, and got crazy offers after 2 years, and had enough smarts to go, pigs get fed, hogs get slaughtered. I'm going to be a little bit on the piggy side of the line, no disrespect to anybody. And they took the money and ran.
Yeah.
So that's where those reviews, you can be planning for something, but having the horsepower to where, okay, sometimes that 5-year plan turns into 8. You've
Yep.
got to be able to have those conversations with the investors and
Yep. And
whatnot, to carry through, and not have the investors turn around and go, you said X years, so I'm not going to, stay in this party.
yes. Michael, you have a lot of common sense, which is not common. So thank you so much.
Thank
How
you,
can our
Steph.
how can our listeners get in touch with you?
If they ever lose track of me, of course, the best way is to reach out to you. So that you're in there, and particularly if they're looking to connect with me, the why, be part of the conversation. I am in the middle right now of completely revamping, so I'm tearing down my website and revamping it. My email will always continue. So if you can post that, the Mike at michael-ryan.com. It's been there since 90. I got that email address in 96.
Okay.
So been there a while. So if you can reach out to me, the email blogs that you mentioned, always happy to add people to that. And then again, the phone number 408-986-1798. That does immediately go to voicemail. Because I work on banking time. It's kind of Monday through Friday. I'm in from 7:30 till 6-ish, but big chunks of the day I'm not interrupt drive. I'm planning drive. So
Okay.
reach out. If somebody doesn't hear back from me, I missed the memo, ping again.
And if they want to join your newsletter, please just mention that on the email to Michael.
Yes.
Michael, thank you so much for making the time. I really appreciate it.
Thank you so much, Steph. Have a blessed day.
You too. Thank you.